All right, Hewlett Packard just reported yesterday after hours. The stock is up a little bit today. Not some amazing thing, not some big surge, but the market's down. The stock is up just slightly. So here is their actual press release. I'm going to focus on GAAP earnings. GAAP is generally accepted accounting principles. I like to focus on that because that's kind of the rule and the standard. Whether I agree with it or not is irrelevant. The point is that's kind of the standard. So first off, they had earnings per share, EPS of 94 cents. They had previously provided outlook of 95 cents to $1.01. So they kind of missed that. Not the worst thing in the world. Remember, my focus is not on the short term, it's on the long term, and we'll get to that shortly with our software. Second quarter revenue of $16.5 billion, up 3.9% from the previous year's similar quarter. Okay, that's for a company like Hewlett Packard, that's pretty significant. I like seeing that. It wasn't some, 20% growth. I get that, but remember, non-sexy companies that don't have a lot of growth potential, people tend to ignore them and drive the prices down, and that's why we're here to look at value investing. Third, $1.3 billion was returned to shareholders in some sort of form of share repurchases or dividends. If you guys know, Warren Buffett and Berkshire Hathaway took an $11 billion position in Hewlett Packard recently. We've had our position for over a year now. It's done very well for us, but the reason Berkshire likes it is share repurchases of a cheap stock in their eyes. Is it cheap? Again, we'll get through that in our software here, but this is the general idea. So here is the recap right here. Revenue up 3.9%. Operating margin down 80 points, 0.8%. Net earnings in the billions down from 1.2 billion down to $1 billion, down 19%. And their EPS went from 98 cents to 94 cents. So guys, a lot of people are sitting here and a lot of people want to react to exactly the news that's right there right now. What I'm trying to teach everyone out there, I used to do exactly what you did. I'd look at every single quarter. What's going on? Now I look at it and say, listen, the only thing I'd look for in the quarter is, are they doing something that makes me go, wait a second, my thesis is wrong. Every quarter is going to be up and down. They're going to miss, they're going to make all these things. I believe Hewlett Packard had actually beaten estimates in the previous 4 quarters. So I don't know what's going on here, but the point is you have to look at the company overall from a value perspective. So let's pull up our software and go through the 8 pillars. And again, if you're a subscriber of our software, please pull it up. It's very nice to go through it while you're listening to the video. So here's our software. Let's go to the 8 pillars tab, type in HPQ. So it's up 2.5% today. It's actually pretty substantial considering the market's down as of this very second. Now let's go look at the max chart. Now here's what I want everybody to see. Look at Hewlett Packard in 2000. It was selling for about where it's at today. So if I told you in 2000, after this big run up, that the stock would go nowhere for 22 years, you'd think I was crazy. Let's actually go look at the income statement going back. Last year, they did $65 billion in revenue. Back in 2000, when they're at the same stock price, they did $43 billion in revenue. So they're 50% more revenue than they are today, and the stock is the same. So if I told you back then, the stock's at 36, 37, revenue is going to go up 50% over the next 20 years, the stock's going to be down. You'd be like, you're crazy, but it happens. Why? Valuation. In 2000, they made $3.3 billion. Last year, they made 6.5, double the profit. So if I told you 22 years ago, the company was going to have double the profit and the stock was going to go nowhere, you would have said, you're crazy. And that's why, valuation. So let's go through our 8 pillars. Let's go to the main page first. Our first pillar, we want the 5-year PE ratio to be under 22.5. It is 10.3. That is a big time check, less than half we want it to be. And last year's PE is 6.6. Pillar number 2, we want the 5-year return on invested capital greater than 9%. This is the return they get on the money invested in the business through debt and equity. Guys, look at this, 52.8%. 2 metrics on the main page. Now, not part of our pillars, but something to keep in mind. Look at their dividend yield. 2.2% pays out about $1 billion. So the reason we have it on this page, you always want to compare dividend to free cash flow to make sure they can afford it. Guys, their 5-year average free cash flow is $4.3 billion. Last year they did $6.3. They can easily afford this dividend. It doesn't even eat up 20% of their last 5 years free cash flow, or 25%. So this is great. Good start so far. Pillar number 3, We want revenue growth over the last 5 years. So 53.89 to 64.87 from our income statement on the software. Check mark there. Again, not huge, but Hewlett Packard is not some amazing growth potential company, and that's okay. You can still make a lot of money on those. Pillar number 4, we want net income growth, profit growth over the last 5 years. So again, we just scroll down on our income statement, 3.85 to 6.5. Check mark there. That is awesome. Okay. Pillar number 5, we want shares outstanding decreasing, especially on a company like this where the PE is so low. We want them buying back shares. This is decreasing the number of shares, and it gives you a bigger and bigger piece of the company. When a company issues shares, they are diluting you as an owner. So scroll all the way down to the income statement. The end of 6 years ago, they had 1.7 billion shares. Now they have 1 billion shares outstanding. Guys, they have less than half the share, almost half the shares they had 10 years ago. They are buying back shares, and I love that they're buying back shares that are cheap. 6.5 times last year's earnings, 10 times last 5 years' earnings. That is super, super cheap from a PE perspective. So far, all the checks I love. Pillar number 5. So guys, when it comes to debt in a company, we want to have companies that have less debt, or they can easily manage their debt through their cash flow. After doing a lot of research, I determined for myself that I want to take the 5-year average free cash flow, and I want to have the long-term liabilities be less than 5 times that amount. So I go back to the main page in our software, and right here on the main, 5-year average free cash flow, 4.3. I multiply that by 5, and that's $21.5 billion. So I want their long-term liabilities to be under $21.5 billion. So where do I go? I just scroll to the top, go to the balance sheet, and go all the way to the bottom of the balance sheet. Their total long-term liabilities is $11 billion, less, almost half that amount. So this means based on their 5-year average free cash flow, they can pay off their long-term liabilities in less than 3 years, about 2.5 years. Based on last year's free cash flow, $6 billion, they can pay it off in less than 2 years. That's incredible, guys. All right. Final 2 pillars have to do with free cash flow. Now remember, guys, free cash flow is the lifeblood of a business. It is cash from operations less your capital expenditures. And there are 5 things a company can do with free cash flow. They can do all of these, none of these, any combination they want. Buy back shares, pay down debt, pay out dividends, reinvest in themselves, or make acquisitions. All right? So on our cash flow statement in our software, we added this line because it's so much easier to do the math when it's done for you. 5 years ago, they did $3.48 billion. Last year, 6.3. That is growth. Check mark there. Now, one thing I want you guys to see, big jumps here. So this is a big jump for the last year. I would not assume this is going to be steady forever. Just like if this plummeted because of some obscure event, last year was a high demand. I see this in a lot of companies. They had big jump in free cash flow or earnings or profit the previous year. You have to stabilize that. Don't give it too much credit. So a check mark there, though. Our final metric, we want to come up with some sort of market cap for the business of what we want to pay. Now, we take this $4.3 billion and we multiply by 22.5, similar to our earnings. It's the 5-year average free cash flow multiplied by 22.5. So 22 times 4 is 88, and a half is 90. Let's call it $90 billion, give or take. $90 billion. We want the market cap to be under $90 billion. So let's go back to the main metrics page. Our current market cap is $43 billion. Big time checks. Guys, if you don't like all that math, guess what? We have the 8-pillar tab here. It does it all for you. It is an 8-pillar thriller. This is average check marks all the way around. So does this mean you go on your computer right now and you buy the stock? No. You need to do more research. This is a great screening process. But what I like so far is what I see here. They're buying back cheap shares. They're a boring company, but they're going to get their returns for the investors by buying back shares. If their profit just stays the same and they buy back half their shares, your earnings per share will double from there. That is the whole key here. That is eventually the market will see that value. Then they'll pay down all the debt. Before you know it, they're just accumulating cash over and over. So do your due diligence, figure that out. So the question becomes, what should you pay for the stock? That's what we're going to use Stock Analyzer tool for right now. This is the most popular part of our software, Stock Analyzer tool. By the way, if you want to do more research on it, go to our community, talk in there, because people really like talking about our community, talk about individual stocks. You can search for HPQ and have a very specific conversation. So, Stock Analyzer tool. We're going to do a 10-year analysis on Stock Analyzer tool to determine, okay, let's give some estimates, because every investment is the present value of all future cash flow, right? We don't know the future. The future is unknown, but we can make assumptions based on history and based on what we see in the future. My goal is to be conservative and then buy when the company is selling for my conservative estimates. So I pick a low, middle, and high range for revenue growth, profit margin, free cash flow margin, PE, and price of free cash flow. And then I put my desired return in. So let's start with that. So in the last 10 years, they've sold off some divisions and their revenue is down. Let's assume this is a dead company. They're going to lose 2% a year. Middle range, they keep their revenue the same. High range, they do 2% revenue growth a year. Profit margin. I'm going to look at the 6, 7, and 8% range. Free cash flow margin. I'm going to do 7, 7.5, 7.5, and 8. PE. I'm going to do 10, 12, and 14. 10, 12, and 14. And then my return, guys, I want 12.5% return. And the reason I picked 12.5% is I can get an ETF and get 9 or 10%. So for proper margin of safety and for giving me a reason to go do this, I'm going to put 12.5%. Once I hit the analyze button, it's going to give me 6 different prices based on earnings and free cash flow. They're going to be green or red. Analyze button, boom. So it's telling me right now that we're just barely above the middle range on both these. So guys, if you want to pay attention to this, put yourself a reminder, add to our watch list. It'll notify you when it hits that price. But this is HPQ. Thanks for watching.